There's a pattern in monetary policy that has transferred trillions of dollars from the middle class to the ultra-wealthy 3 times in the last 100 years. And right now, in 2025, we're watching the exact same setup that created every billionaire fortune you see today. In 1921, the Federal Reserve raised rates to crush post-war inflation. Prices fell 18% in 12 months. Small businesses collapsed by the thousands. Those with cash bought everything at depression prices. In 1933, the Fed let interest rates spike in real terms during deflation. 9,000 banks failed. Asset prices fell 60%. Family farms foreclosed. Industrial empires changed hands. Those who held cash in 1929 multiplied their wealth while the middle class lost everything. In 1982, Paul Volcker raised rates to 20% to fight inflation. 11,000 businesses failed in 6 months. Unemployment hit nearly 11%, and a small group with access to capital bought American industry for pennies on the dollar. 3 times. 3 rate shocks. 3 massive wealth transfers. The pattern is identical every time. Central bank raises rates to fight inflation, debtors collapse under impossible borrowing costs, assets flood the market at fire sale prices. Those with cash consolidate everything. Here's what should terrify you. The billionaire class you see today, the wealth gap that feels impossible to close, the sense that the game is rigged, it all traces back to 18 months in 1980 to 1982. The top 1% controlled 22% of American wealth in 1978. Today they control 39%. That's not economic growth. That's transfer. And here's the part nobody talks about. When Volcker announced he was raising rates in October 1979, the financial press called it necessary medicine. Economists praised his courage. The wealthy quietly positioned themselves. They knew exactly what was coming. Because this wasn't the first time, it was the third. And they had studied the pattern. This is the story of how the greatest peacetime wealth transfer in American history happened in plain sight, why everyone called it fighting inflation, and why the mechanism was designed to work exactly this way. Let me show you how this actually worked, because the story you've been told about 1980 leaves out the most important part. On August 6, 1979, Paul Volcker walked into the Federal Reserve building as the new chairman. Inflation was running at 13.5%. By March 1980, it hit 14.8%. Everyone agreed something had to be done. The newspapers demanded action. Economists called for tougher measures. The Carter administration was desperate, and the solution seemed obvious to everyone: raise interest rates high enough to stop people from borrowing and spending. Kill demand, kill inflation. Simple economics, right? That's the story. But here's what that story leaves out. When Volcker raised the federal funds rate from 11% in late 1979 to 20% by June 1981, he didn't just make borrowing expensive. He created 2 completely different economies operating in the same country at the same time. If you had cash, you could suddenly earn 20% returns risk-free by lending to the government. 20%. No stock market gambling. No real estate speculation. Just park your money in treasury bills and watch it grow by 1/5 every single year. But if you had debt, you faced financial annihilation. Your mortgage payment didn't change, but try getting a new one at 18%. Your business loan came due for renewal, and suddenly the bank wanted 21.5%, the prime rate in 1981. Your credit card balance that was manageable at 12% was now compounding at rates that would double your debt in 4 years. The math wasn't complicated. It was brutal. And it guaranteed exactly one outcome. Wealth would transfer from people who owed money to people who had money to lend. This wasn't a side effect. This was the mechanism. Now let me show you what happened to that wealth, because this is where the comfortable story about fighting inflation falls apart completely. In 1978, the top 1% of Americans controlled 22% of the nation's wealth. Not good, but not catastrophic. By 1983, after just 18 months of Volcker's 20% rates, that same group controlled 33.8%. By 1989, 37.4%. We're not talking about slow accumulation over generations. We're talking about the largest peacetime wealth transfer in American history, happening in less time than it takes to get a college degree. And here's the number that should make you stop and think. That wealth share has never gone back. Today, the top 1% controls 39%. The gap that opened in those 18 months never closed. It widened. Because once wealth concentrates, it compounds. This isn't a story about monetary policy or inflation targeting or any of the comfortable economic terms we use to avoid saying what actually happened. This is a story about a pattern that has worked 3 times in 100 years, and every time it works the same way. Raise rates, collapse debtors, buy everything, consolidate forever. To understand why this pattern keeps working, you need to see it in its purest form. October 1929. The stock market crashes and everyone knows that story. But here's what they don't teach you. The Federal Reserve had a choice. They could have expanded the money supply to cushion the fall, kept credit flowing, prevented deflation. They didn't. Between 1930 and 1933, they let the money supply contract by 30%. 30%. Prices fell at the same rate. And here's where it gets critical. When prices are falling 30%, but your debt stays exactly the same in dollar terms, suddenly every dollar you owe is worth 30% more in real purchasing power. If you borrowed $1,000 to buy your farm in 1929, by 1933, you needed to pay back the equivalent of $1,300 in real terms. Except farm prices had collapsed, wages had collapsed, and you were still on the hook for the original amount. This is how deflation transfers wealth. It makes every debt heavier while making every dollar of cash more valuable. Real interest rates spiked above 10% even though nominal rates were falling. You couldn't see it in the numbers the banks advertised, but you could see it in the 9,000 banks that failed between 1930 and 1933. You could see it in unemployment going from 3% in 1929 to 25% by 1933. You could see it in the foreclosures that swept across the farm belt and through industrial centers. Even profitable businesses failed, not because they were poorly run, but because they couldn't service debt that was getting more expensive in real terms every single month. And then came the fire sale. Asset prices collapsed 40 to 60%. Farmland values cratered. The stock market lost 89% of its value from peak to trough. Small businesses liquidated inventory at whatever price they could get. Family farms that had been in the same hands for generations were foreclosed on and sold at auction. But here's the part that matters. The wealth didn't disappear. It just changed hands. Those who held cash in 1929 could buy everything at 40 cents on the dollar by 1932. Corporate concentration accelerated as small competitors were liquidated and their assets absorbed by larger firms with access to capital. The wealth share of the top 0.1%, the very richest Americans, reached its historic peak. The middle class saw their savings, their homes, their businesses evaporate, not because the assets stopped existing, but because ownership transferred to people who had understood what deflation does and positioned themselves with cash before the shock hit. Irving Fisher, the economist who lost his own fortune in the crash, later documented this mechanism and called it debt deflation. Ben Bernanke would confirm Fisher's research decades later. The Federal Reserve transcripts show they understood exactly what was happening at the time. They called it necessary liquidation, purging the rot from the system, letting the weak fail so the strong could thrive. Andrew Mellon, Treasury Secretary and one of the richest men in America, famously told Hoover to liquidate everything and let it purge the rottenness out. Mellon knew the pattern. He was positioned to benefit from it. Now let me show you how this pattern works even faster when conditions are right. 1920. World War I just ended. Wartime inflation has prices running hot. The Federal Reserve decides to force them back down by tightening credit. What happens next is the sharpest deflation in 140 years of American economic data. Prices fall 18% in a single year. Wholesale prices crater 36.8%. Unemployment doubles from 5.2% to 11.7% in 12 months. Businesses that were profitable in January are bankrupt by December, not because anything changed about their operations, but because the Fed deliberately crashed prices while their debts stayed fixed. Same sequence as the Great Depression, just compressed into 18 months instead of 4 years. Those with capital bought industrial assets and farmland at depression prices. The recovery, when it came, benefited asset holders while workers faced years of suppressed wages. The pattern executed perfectly in record time. But here's where it gets truly global, because Volcker's 20% rates in 1980 didn't stop at American borders. All through the 1970s, developing nations borrowed heavily in dollars. Mexico, Brazil, Argentina, a dozen others. The loans made sense when dollar interest rates were 7 or 8% and commodity prices were high. Then Volcker raised rates to 20%, and suddenly every government, every business, every borrower in Latin America who had debt denominated in dollars faced interest payments they physically could not make. The debt didn't change. The rates did. And the math became impossible overnight. August 12, 1982. Jesus Silva Herzog, Mexico's finance minister, sends a letter to international creditors. Mexico has $80 billion in debt and cannot make Monday's interest payment. He flies to Washington and walks into meetings with Volcker, the Treasury Secretary, and the IMF director to announce that Mexico is defaulting, not because of corruption or mismanagement or fiscal irresponsibility, but because interest rates set in Washington made the debt impossible to service. Within months, 16 countries across Latin America faced the same crisis. Over $315 billion in debt needs restructuring. The entire region enters what economists would later call the lost decade. Here's what happened next, and this is critical. American banks didn't lose money. The IMF, funded partly by U.S. taxpayers, bailed out the creditors. Mexico and the others got emergency loans with brutal conditions attached. Austerity measures cut Mexican wages 20 to 40%. Government assets were privatized and sold off. And guess who bought them? American corporations with access to dollar capital, scooping up Mexican industries at fire sale prices while Mexican workers saw their purchasing power collapse. The wealth didn't disappear. It flowed from the global south to dollar holders in the north. Same pattern, same sequence. Interest rate shock triggers debt crisis. Debt crisis forces asset sales. Those with access to the currency that matters consolidate everything. The only difference, this time it crossed borders. Volcker's domestic policy to fight American inflation created a hemispheric wealth transfer. 3 examples now. 1921, domestic deflation shock compressed into 1 year. 1929 to 33, banking collapse and 4 years of contraction. 1982, global interest rate shock that bankrupted entire countries. 3 different centuries, 3 different contexts, identical sequence every single time. The only variable that matters, are you holding cash or debt when the shock hits? Those who control monetary policy understand this pattern. They've seen it work before. They just never call it wealth transfer. They call it necessary adjustment. They call it restoring stability. They call it fighting inflation. But the mechanism is always the same, and the outcome never changes. So how does this mechanism actually work? Why does it succeed every time? Let me walk you through the 4 stages, because once you see them, you'll recognize the pattern instantly. Stage 1, the interest rate shock. The central bank raises rates, usually to fight inflation, and borrowing costs spike overnight. If you have cash, you suddenly earn massive returns just by lending to the government, risk-free. But if you have debt, you face impossible payment schedules. Here's the key. Debt service costs rise faster than income can possibly adjust. A business running on 15% debt load suddenly faces 20% interest rates. Their operating profit gets consumed entirely by interest payments. They can't pivot fast enough. They can't renegotiate contracts fast enough. The shock is immediate. The adjustment takes years, and most don't survive the gap. Stage 2, the debt crisis. Businesses that were profitable last quarter go bankrupt this quarter, not because anything changed about their operations or management, but because of pure arithmetic. At 20% rates, you need 20% operating margins just to break even on debt service. Most businesses run 5 to 10% margins. The math makes bankruptcy inevitable. They can't refinance because nobody's lending at rates they can afford, and the old loans come due at rates that exceed their entire revenue. This isn't market discipline separating good businesses from bad. This is a policy-induced extinction event that kills profitable operations because debt contracts are fixed in nominal terms and can't be renegotiated fast enough. Stage 3. The asset fire sale. Bankruptcy law forces liquidation. Equipment, real estate, inventory, entire. Companies flood the market at the same time. Prices collapse 40 to 70% below pre-shock values because there are thousands of desperate sellers and almost no buyers. Why no buyers? Because credit has disappeared. Banks aren't lending. The only people who can purchase anything are those who already have cash, and they're the minority. This isn't a market correction reflecting true value. This is forced liquidation at distressed prices, and the timing is everything. Assets that were worth $1 million in stable times sell for $300,000 during the crisis, then appreciate back toward $1 million once rates normalize. Stage 4. Wealth consolidation. Those who held cash before the shock buy entire industries for a fraction of their value. No competition, because everyone else is either bankrupt or can't access credit. They acquire assets that will appreciate back to normal values as soon as the crisis passes, generating permanent returns of 300 to 500%. The wealth doesn't disappear. It transfers from debtors who are forced to sell to cash holders who are positioned to buy. And here's why it can't be stopped once it starts. Debt contracts are legally binding. Bankruptcy courts enforce liquidation. Credit markets freeze. The only people with buying power are those who position themselves before the shock. It creates a self-reinforcing spiral where forced selling drives prices down, making more businesses insolvent, forcing more selling. Those who understand this pattern don't try to stop it. They position themselves to profit from it. Now watch how the pattern executed in real time during 1980 to 1982, because every stage is documented in Federal Reserve data, bankruptcy filings, and wealth surveys. October 6, 1979. Volcker announces the Fed will target money supply instead of interest rates, and within months, the federal funds rate climbs from 11% toward 20%. By June 1981, it hits 20%. The prime rate, what banks charge their best customers, reaches 21.5%. 30-year mortgages sit in the high teens. Anyone with cash can earn 20% risk-free returns. Anyone with debt faces financial execution. Stage 1 complete, verified in the Federal Reserve's own historical database. Stage 2 hits fast. In the first half of 1982 alone, 11,948 businesses fail. That's more than failed in all of 1980, which saw 11,742 total failures. The failure rate doubles in 6 months. Unemployment climbs from 7.4% in 1981 to 10.8% by December 1982. But the damage isn't evenly distributed. Manufacturing loses 90% of all jobs shed during the recession. Residential construction hits 22% unemployment. The auto industry reaches 24%. These aren't abstractions. These are small business owners who built profitable companies over decades, only to watch them collapse because they can't service debt at rates that didn't exist when they borrowed the money. Dun & Bradstreet tracked every failure. The Bureau of Labor Statistics documented every job lost. The debt crisis is verified in granular detail. Stage 3 is where it gets predatory. Corporate debt-to-net worth ratios jump from 30.4% in 1982 to 46% by 1987. Companies are desperate for capital, and into that desperation walks Michael Milken at Drexel Burnham Lambert. He creates a $150 billion junk bond market by the late 80s, providing capital to companies that can't get traditional bank loans, but at rates and terms that favor the lenders. Leveraged buyouts explode. Kohlberg, Kravis Roberts, Carl Icahn, a dozen corporate raiders use Milken's junk bonds to buy entire companies for 10 to 20 cents on the dollar. They load the targets with debt, strip assets, flip them for profit. This isn't capitalism rewarding efficiency. This is opportunistic consolidation during forced liquidation. The Federal Reserve's own debt data shows the spike. Drexel's records document the deals. Stage 4 delivers the knockout. The top 1%'s wealth share goes from 22% in 1978 to 33.8% by 1983 to 37.4% by 1989. The top 0.1%, the truly wealthy, see their share climb from 7% in 1979 toward 22% by 2012, and the trajectory starts right here. Meanwhile, the middle 40%'s wealth share peaks at 37% in 1986, then begins terminal decline. The bottom 90% starts losing ground they'll never recover. Survey of Consumer Finance's data tracks this. Saz and Zuckman's wealth distribution research confirms it. And here's the number that proves the mechanism worked exactly as designed. Michael Milken personally earned $550 million in 1987 alone, the highest annual income in American history to that point, by facilitating the transfer of industrial wealth from Main Street businesses to Wall Street raiders. We're living in the aftermath right now, the billionaire class you see today. Their fortunes trace directly to this 18-month window. Those who held cash in 1980 multiplied their wealth 10 to 20 times. Those who held debt lost everything. The gap never closed, it accelerated, because once wealth concentrates, it compounds. In 1980, the top 1% controlled 22% of wealth. Today they control 39%. That 17-point gap opened in 18 months and never went back. The pattern. Executed successfully for the third time in 100 years, and every stage is documented in public records.